You know the direction, you've picked your calls and puts, but you're still losing money. The problem isn't your strategy, it's your contract. There are hundreds of numbers blinking on your options chain screen right now, and picking the wrong one is the fastest way to lose money on a trade you should have won. Here's how to read the options chain correctly so you never pick the wrong contract again. Most traders ask, where is the stock going? Consistent traders ask, which contract is the best deal? In this episode, you'll learn exactly which numbers on the options chain matter so you can choose contracts with confidence. Imagine you walk into a new restaurant. The menu is huge, 50 dishes, different prices, long descriptions. You don't pick at random. You think, what am I in the mood for? What's my budget? Why is this more expensive than that one? You compare your options. An options chain works the same way. Instead of what I'm in the mood for, you're asking which contract's actually a good deal. Let me show you exactly what I look for. When you open your options chain, there's a lot of data cluttered on your screen. Strike prices, bid and ask, implied volatility, volume, open interest, and the Greeks. Don't worry about the Greeks yet, that's a future episode. On one side of the chain, usually the left side, you got your calls for when you're bullish. On the right side, you've got your puts for when you're bearish. Right down the middle, you've got your strike prices. Let's just focus on 5 columns: strike price, bid and ask spread, implied volatility, volume, and open interest, and what they actually mean for your money. There are 3 zones for strike prices. Let's use Tesla at 455 as an example. For calls, you've got ITM, in the money calls, which means the stock price is higher than the strike price. So when Tesla's at 455 and your call is at 450, this call already has built-in value, intrinsic value. It is $5 deep in the money. ATM, at the money calls, means the stock price is exactly at the strike price or very close to it. So when Tesla and the strike is 455, even a 456 strike is considered at the money. It's got no built-in value yet, but since it's so close to the action, it has major potential. OTM, out of the money calls, the stock price is under the strike price. A $460 call, it is $5 away from Tesla's price of 455. This is also just extrinsic value, it's pure speculation. For puts, we just flip it. In the money puts, the stock price is lower than the strike price. At the money puts, the strike price is equal to the stock price. Out of the money puts, the stock price is higher than your strike price. Simple rule. In the money costs more because it has real value. Out of the money is cheaper because it's a maybe. And cheap often means you need a massive move just to profit. Imagine a farmer's market. 10 vendors are selling apples from the same orchard, but prices and crowds are totally different. You're thinking, is this price fair, and will this vendor still be here when I need them? An options chain is the same thing. Same stock, same strikes, different activity levels. Some contracts are easy to trade, others aren't. 3 numbers tell you which vendor is active. First up, we got the bid and ask. The bid is what buyers will pay right now. The ask is what sellers want. The gap between them is the spread. My rule, I never trade a contract where the spread is more than 5% of the mid price. For example, Tesla 460 call, bid 250, ask 260, mid 255, spread is 10 cents. You're only $10 down the moment you buy. Compare that to a bid of 240 and an ask of 280, that's a 40-cent wide spread. That's $40 gone instantly before the stock even moves. A busy vendor has a tight spread. You buy and sell fast with minimal loss. Next, you got implied volatility. IV tells you how big a move the market expects. High IV equals big expected swings and more expensive options. Low IV equals smaller swings and cheaper options. Let's say Tesla has earnings next week. Everyone expects a big move. IV spikes to 100 and the $460 call costs you $8. The day after earnings, the results are out, the uncertainty is gone, and IV collapses to 30. Even if Tesla jumps 10 points, that same contract might now be worth only $5. That's IV crush. Your premium got wiped out even though you were right on direction. Finally, volume and open interest. Volume is how many contracts traded today. Open interest is how many contracts exist total. A contract with 500 trades today and 5,000 held total is an easy buy, easy sell. A contract with just 2 trades today and 30 held total could be an easy buy, but a hard sell when you need to. Always trade liquid contracts. So, which strike do you actually pick? Welcome to the Goldilocks zone. Nothing too close, nothing too far. If Tesla's trading at $455, you should be looking at strikes between 430 and 480. Before you pick a strike, ask yourself, what move do I actually expect? If you think Tesla is going from 455 to 465 in 2 weeks, buy the 460 call. If you think it's going to crash to 440, buy the 450 put. Your strike price should always match your thesis, not the cheapest price on the screen. One last thing, and it's really important, time. You'll see expirations from tomorrow to 18 months out. Never buy options with less than 30 days to expiration. Time decay accelerates in that final month. My sweet spot is 30 to 45 days. This gives my thesis room to breathe and time to work out. I get lower daily decay and a reasonable cost. Yes, longer dated options cost more upfront, but I'm not paying for a higher price, I'm paying for survival. A $300 option with 45 days left is infinitely better than a $50 option with just 3 days left. Pay for time, save yourself the stress. Let's walk through a real trade. Apple is currently right around $270. You think the momentum heading into January will be strong and you expect it to hit 280 to 285 in about 3 weeks. Step 1, call or put. You're bullish, so you're buying a call. Step 2, which strike? We'll look at the $280 strike. That's about $10 above the current price, right in that 5 to 10% Goldilocks zone. Step 3, which expiration do I choose? We pick a date 30 to 45 days out. That hits our sweet spot. The bid is $290 and the ask is $295. The spread is only 5 cents. That's tight and liquid. Good. The IV is 20%. That is fair. We aren't overpaying. So good. The volume 280 and the open interest is 1600. Great. Step 5, calculate the break even. A $280 strike plus a $3 premium equals a break even of $283. Step 6, ask yourself, is this realistic? Can Apple move from 270 to 283 in 3 weeks? This is about 4.4%. Given January catalyst, that move is realistic. Buy it. Second example is a comparison. Now, let's look at why the strike price isn't always the same deal. Imagine you see another $360 call. The bid is $2.20, but the ask is all the way at $2.90. That is a 70-cent spread. You're losing $70 the moment you click buy. Now look at the activity. Only 4 contracts traded today, and only 83 exist in total. It's an empty vendor stand basically. Even if you manage to buy in, you're going to have a nightmare trying to sell. That's a toxic contract. Skip it. Final example. Imagine 3 vendors all offering $360 calls. Option A, bid is $250, ask is $260, volume is $150, open interest is $2,400. Option B, bid $240, ask $310, volume $12, OI is $89. Option C, bid $245, ask $255, volume $340, and OI is $5,100. Which one do you pick? Most pick C simply because it has the lowest ask price. But let's use seasoned logic. First, eliminate option B. That 70-cent spread and tiny volume mean it's a dead end. Now it's option A versus option C. Both have tight spreads and both are fairly priced. But look at the inventory. Option C has over 5,000 active contracts compared to option A's 2,400. When you want to exit, option C is liquid. You sell immediately. With option A, you might wait or take a worse price. The cost difference is 10 cents. The difference in your ability to execute is huge. Now, let me save you thousands by pointing out what destroys new traders. Mistake 1, buying the cheapest strike. You see a 50-cent option and buy it, but it needs 15% move just to break even. That's speculation, not trading. Second mistake, buying short expirations. Buying the 3-day option because it's cheaper, the contract becomes worthless before the stock even moves. Mistake number 3, ignoring the numbers. You ignore the spread and get ripped off on entry and exit. You ignore IV crashes. You ignore volume and open interest, and you get trapped in a dead-end contract. Another mistake is micro cap stocks. You think they're cheaper and have more potential. They're not. They are illiquid, dead vendors, massive spreads. You'll get destroyed. You need a consistent approach. Check all 3 metrics before you buy. Tight spread? Yes. Fair IV? Yes. Decent volume? Yes. All 3 yes, buy the contract. Missing one? Skip it. There's always another trade. Before buying any option, run the 6-point checklist. 1. Is my strike price within 5 to 10% of the stock price? 2. Does my expiration date give me at least 30 days? 3. Is the spread tight? 10 cents wide max? 4. Is the IV reasonable? We're looking for the 20 to 70 range. 5. Is there decent volume and open interest? 6. Does my break even match my thesis, and does the math make sense? Yes to all 6, buy it. No to any, skip it. Always run the list. Save yourself the headache. You now know how to read an options chains, the zone, the numbers, and the common mistakes. This is the single skill that separates traders from gamblers. This is your homework. Open your broker, pick a stock you know well, find a call and a put at the same strike, and run them through the 6-point checklist. Post your findings in the comment. I want to know. In episode 4, we built credit spreads. That's what I promised in episode 2. I'm going to talk about how to combine 2 contracts into one defined risk trade that takes advantage of time decay for profit. Then, episode 5, we unlock the Greeks, delta, theta, gamma, and vega. These control exactly how your option moves. If this entire process finally clicked for you, hit that like button, subscribe so you don't miss episode 4, comment below what stock are you running the checklist on. Trade smart. See you in the next one.